Bitcoin shocked the entire crypto world with a move that few saw coming, sending ripples of anxiety and disbelief through markets across the globe. The suddenness of the event left both seasoned traders and casual investors scrambling for answers, as the digital currency's reputation for wild swings was put on full display once again. On November 18, 2025, Bitcoin plunged below the critical $90,000 mark, a level it hadn't touched in over 7 months. The drop was not just a minor dip, but a dramatic fall that caught even the most experienced market watchers off guard. In a matter of hours, nearly 30% of Bitcoin's value evaporated, wiping out gains from its late October peak of $126,000. The speed and scale of the decline were breathtaking, leaving portfolios battered and confidence shaken. This sharp correction didn't just erase profits, it shattered the bullish optimism that had been building for months. It served as a stark reminder of the cryptocurrency market's notorious volatility, where fortunes can change in the blink of an eye. At its lowest point, Bitcoin's price hit $89,571, breaking through a key psychological support level. This breach sent shockwaves through the market, forcing traders and investors to quickly reassess their strategies and expectations for the future. Investors who had been riding the wave of confidence now faced the sobering reality of a possible prolonged downturn. The mood shifted from excitement to caution, as uncertainty about what might come next began to dominate conversations. The big questions on everyone's mind: what exactly triggered this sudden collapse? And more importantly, is this the start of a deeper, more painful bear market for Bitcoin and the broader crypto space? Several factors converged to create the perfect storm. Technical analysis began flashing warning signals as key support levels failed. At the same time, growing macroeconomic worries, like persistent inflation and fears of a looming recession, added to the pressure. Meanwhile, institutional investors, who had fueled much of the previous rally, started to pull back, leading to a noticeable drop in trading volumes and market liquidity. Understanding how these forces interacted is crucial for anyone hoping to make sense of Bitcoin's dramatic price action. Each element played a role, amplifying the impact and accelerating the sell-off. In the next segment, we'll break down the key drivers behind this sudden market shift, exploring how technical, economic, and psychological factors combined to send Bitcoin tumbling, and what it could mean for the future of crypto. In the world of technical analysis, few signals strike fear into the hearts of traders, quite like the infamous death cross. This ominous-sounding pattern has a long history of rattling markets, and when it appeared on Bitcoin's chart, it sent a wave of anxiety through the trading community. The death cross occurs when a short-term moving average, typically the 50-day, falls below a long-term moving average, usually the 200-day. For Bitcoin, this crossover is seen as a classic sign that bullish momentum is fading and that a deeper correction could be underway. This technical event is more than just lines on a chart. It's a signal that the market's psychology is shifting. When the 50-day moving average dips under the 200-day, it suggests that recent price action has been weak enough to drag down the overall trend, often leading to increased selling pressure. While the death cross isn't a flawless predictor of future price action, it's a powerful psychological trigger. Many traders and investors watch for it, and its appearance can quickly turn cautious optimism into outright fear. After Bitcoin lost the crucial $94,000 support level, selling accelerated rapidly. The death cross only confirmed what many feared: the bullish trend had reversed, and a bearish phase was taking hold. For many traders, this was the green light to sell or even short Bitcoin, amplifying the decline as panic spread. The rush to exit positions created a feedback loop, driving prices even lower. It's important to remember that the death cross is a lagging indicator. It reflects what's already happened, not what's about to happen. Yet, its psychological impact is undeniable, often sparking a self-fulfilling sell-off as traders rush to avoid further losses. The technical breakdown, combined with mounting anxieties about the broader market, made the recent bull run feel like a distant memory. Confidence evaporated almost overnight, replaced by caution and uncertainty. With analysts and financial news outlets highlighting the death cross, traders now had a clear reason to expect more downside. The narrative shifted decisively from hope to fear. For now, the technicals point to caution and consolidation. Until a new catalyst emerges, traders are likely to remain on edge, watching for any sign that the worst might finally be over. Beyond charts, macroeconomic fears fueled the sell-off. Hopes for a Federal Reserve rate cut faded as officials signaled caution, making riskier assets like Bitcoin less attractive. High interest rates pull money toward safer investments, draining capital from crypto. The market's focus shifted to the Fed's December meeting, with every hawkish comment sparking more selling. Bitcoin, once seen as immune to traditional finance, now moves in sync with global economic anxieties. Tight credit conditions and central bank caution have become major headwinds for digital assets. In today's market, crypto is no longer insulated from the same fears that move stocks and bonds. Market uncertainty deepened as investors and analysts found themselves navigating without the usual stream of fresh economic data. This disruption was triggered by a recent U.S. government shutdown, which brought the release of critical reports to a sudden halt. The absence of new information left the financial world in a state of limbo, amplifying anxiety across Wall Street and beyond. Key reports, such as the all-important non-farm payrolls, were postponed indefinitely. These reports are vital for understanding the health of the economy, and their delay left both investors and the Federal Reserve essentially flying blind. Without these benchmarks, it became nearly impossible to gauge the true state of economic growth or labor market strength. In the absence of timely data, traders were forced to rely on speculation, rumors, and incomplete information. This uncertainty led to wild swings in the markets, as every small piece of unofficial news or rumor was magnified, causing volatility to spike. The missing data pipeline meant that everyone, from Wall Street economists to Main Street investors, was left guessing about the Federal Reserve's next move. With no clear signals, predictions became little more than educated guesses, and confidence in market direction eroded. This information vacuum heightened anxiety and made markets hypersensitive to even the slightest hint of news. Investors and traders scoured every headline, social media post, and analyst comment, searching for any clue that might offer an edge or insight. As a result, many investors chose to reduce their risk exposure, scaling back positions and preparing for potential shocks once the backlog of data was finally released. The uncertainty prompted a defensive stance, with portfolios adjusted to weather any sudden surprises. The anticipation of new data created a tense, risk-off environment. Every trader and analyst was on edge, waiting for the moment when the floodgates of delayed information would open and potentially reshape market expectations overnight. In this climate, even the smallest news item or rumor could trigger outsized reactions. The lack of context made it difficult to separate signal from noise, so markets lurched in response to every development, no matter how minor. The prevailing motto became clear: sell first, ask questions later. In times of uncertainty, caution ruled the day, and the markets moved with a hair-trigger sensitivity to any new information. Another blow came as institutional investors pulled back from Bitcoin. Earlier in 2025, strong inflows into spot Bitcoin ETFs fueled the rally. But as volatility rose and macro uncertainty grew, big money paused, slowing ETF inflows to a trickle. This retreat removed a key pillar of support, signaling a shift in risk appetite. Crypto-related stocks and mining firms also tumbled, amplifying the sense of caution. The absence of institutional buyers left the market more vulnerable to sharp corrections. Their hesitation showed how closely crypto now tracks traditional finance. When the big players step back, the whole market feels it. The sell-off was supercharged by massive liquidations in the crypto derivatives market. Leveraged traders, betting on higher prices, were forced to sell as Bitcoin fell below key levels. Earlier in November, over $19 billion in leveraged positions were wiped out in a single day. As prices dropped, a cascade of forced selling triggered a vicious cycle, deepening the crash. Automated liquidations flooded the market with supply, accelerating the decline. This internal market dynamic turned a correction into a rapid, brutal plunge. It wasn't just cautious investors selling, algorithms and margin calls did the rest. The combination of leverage and fear created a perfect storm. In crypto, small moves can quickly spiral into major collapses. Bitcoin's fall dragged the entire crypto market down with it. Major altcoins like Ethereum, Solana, and Cardano all dropped by similar or greater percentages. Even meme coins like Dogecoin weren't spared, showing the sell-off was broad and indiscriminate. The synchronized decline highlighted how tightly correlated crypto assets are, especially in times of stress. Investors weren't rotating between coins, they were exiting the space altogether. The risk-off mood hit everything from blue-chip tokens to speculative projects. When macro fears strike, few assets can swim against the tide. The sea of red on November 18th was a stark reminder of crypto's interconnectedness. In a bear market, almost nothing is immune. The mid-November correction was a perfect storm of bearish forces. Technical breakdowns like the death cross signaled trouble, while macro uncertainty over Fed policy fueled risk aversion. Institutional buyers paused, ETF inflows dried up, and delayed economic data left everyone guessing. High leverage in derivatives markets turned a modest drop into a cascade of liquidations. Each factor alone could have caused turbulence. Together, they overwhelmed the market. The result: a rapid reset of expectations and a sharp increase in perceived risk. Crypto's integration with traditional finance made it more vulnerable than ever. The correction wiped out weeks of gains and reminded investors of the market's fragility. In crypto, risk can escalate in a heartbeat. With the dust settling, all eyes are on what comes next. The Fed's next moves and the release of delayed economic data will set the tone. A weak jobs report could revive hopes for rate cuts and spark a rebound. Strong data might trigger more selling. Bitcoin's ability to find support above $88,000 or reclaim $90,000 will be closely watched. Institutional flows into Bitcoin ETFs will signal whether big money is returning or staying cautious. The recent correction proved how closely crypto tracks global finance. Investors must now watch central banks, economic data, and risk appetite across all markets. Navigating the volatility ahead means staying alert to these key signals.